with all that's happening as far as the expectations on interest rates go, let's get perspective. Market expert Manish Singh is joining us from London. Manish, always good to have you with us on the show, but tell us now, how is this inflation data likely to be read by the FOMC, and how much of this is going to play out on the kind of rate decision? Because market sentiment seems to be positive on the possibility of interest rate cuts that we will see one by September.
Hi, good evening, Vikram, to you and your viewers. Yes, the data has been soft, and it doesn't come as a surprise because if you look at some of the recent numbers, they were indicating that apart from few sectors, which is rent and OER and other things that we have discussed in the past, all the other numbers are coming on the softer side. And to your point about rate cut, now we have to bear two things in mind, is that if you look at the amount of interest income and dividend that the US savers are earning, or investors and savers are earning, that is really helping the economy. So if you see what FOMC is faced with, they are faced with an economy that refuses to go into recession. And there's a reason, because the dividend income and interest income is high, and that's helping the economy. Whereas if the inflation continues to come down, then the Fed is faced with the decision that the real rate, which is the nominal minus the inflation rate, just gets higher and higher. And that means the policy in real terms become restrictive. So let's not look at 5.5%, which is obviously the baseline rate at the Federal Reserve that one has to pay on borrowing and lending, but look at the real rates. And so if you are sitting on FOMC, you will be mindful that that real rate does not become too high. So I'm in the camp that we should get a first rate cut at July meeting, not tonight, but the next meeting. And the basis of that, my thinking is that real rates will continue to go more positive because inflation will continue to come down. And does the economy need a rate cut? Probably not at this point, but real rates will become a factor. Down the line, if Fed does not react in time, then it doesn't want to see a recession or signs of it setting in as unemployment goes up. And you saw the jobs report last week on the Friday, though it was slightly higher than expectation, but in overall terms, the unemployment rate rose. So these are conflicting things that Fed has to balance in mind. If they look at real rates, they should be cutting in July. If they're waiting for recession, then they can continue to hold on longer.
Whenever that comes, that might be a long time in the coming. And every time there is this kind of data, Manish, we see that kind of move and the expectation is built in the markets. Based on this dichotomy of the strength in the economy and the possibility of a recession somewhere down the road, how do you see the markets in the US move? How do you see Wall Street right now, which is upbeat, and the bond markets as well? What kind of reactions do you expect? Will we keep having this kind of pendulum effect based on the kind of data that comes out? Even a slight softening elicits that kind of response?
So for now, I maintain that equities will be higher. And you have seen that move in US 10-year yield as well. If you saw the move between Friday and today, it's just a mirror image. The yield went up by about 20 basis points or more, and then it has given up all that yield because today suddenly the market decides that that rate cut is definitely coming closer. And so the yields have fallen and equities have rallied. Now, equities are going to rally if yields come down, but equities are also going to rally because earnings are doing well. And as I just mentioned, that if you look at the amount of savings return through interest income, dividend, and I'm not even talking about property prices, which gives to wealth effect, and also equities higher, that gives to wealth effect, that keeps the spending power. Though it has been reduced, but it is not reducing to a point where one starts worrying about recession. Remember that almost 80% of the consumer, 80% of the consumer spending in the US comes from middle and upper middle income. So if these are the savers who are making money on interest and dividend income, they have the spending power. So I'm not talking about the breadth of the US economy where everyone is doing well. In some parts in America, it is back to 1970s level poverty. But aggregate level, the spending is not at a point where it's going to turn suddenly. And that keeps the Fed on hold. And that will keep the equities higher because those are coming through better earnings.
More than inflation, if you look at the Indian context as well, and we are seeing the course of the ability to draw in investments at this stage. It's going to be a big ask for the Modi government, which is hitting its hat trick now. Looking at what the possibilities are in trying to push for infrastructure spending and more schemes, and that's likely to come through in the budget. The CPI inflation that we're looking at in India, that's also easing. Do you see a case where growth will get more momentum if the RBI decides to move even before the Fed does?
Possibly, yes. I think it's very nuanced, so difficult to say what the short-term impact will be, because some of these policy measures, it takes time to flow through. I mean, even if you look at the lag effect of the high interest rate that you've had in the US, very perversely, that has helped the US economy, as I just mentioned, because of interest income and given where the levels of savings and dividend are, which is not quite the case, in my opinion, if you look at India. So a rate cut is clearly going to help because it is still a growth economy where still a lot need to be spent. There's still a lot of borrowing required, and that clearly has to be at a lower rate for businesses, entrepreneurs, and everyone to get the capital. So absolutely, I think that inflation keeps coming down and RBI eases the rates, then that should help economic growth and in turn equity as well, because those are based on earnings.
Very much for your perspective, Manish Singh, market expert, joining us from London to break down what is expected of the FOMC meet and how this data that we are seeing on the inflation front in the US is going to kind of raise expectations in the markets of a rate cut sometime by the month of September. And he says that if we are to look at the possibility of a recession coming through, we'll have to wait longer than that. But if you look at data in itself in isolation, then perhaps it could happen early by July even. Meanwhile,
if you like this video, then like, share and subscribe to ET Now.